Hello and welcome subscribers to the Saturday Summary for March 15th, 2014, your weekly summary of market and economic news for annuity and life insurance professionals. I'm Jonathan Illig of Brokers Alliance in for the Biz. Let's start with a review of the week. Now this week was rough on the bull, as the predicted volatility, in this case downward volatility, resulted in declines in the broad market indexes that are tracked by the summary. As you can see here, the indexes all lost ground this week, some more than others. Now the S&P 500 slipped back into negative territory year to date, and the Dow Jones Industrial Average has not yet closed positive for the year. Now as we see here, for the week, these broad indexes lost ground. Now what's driving this train? Well, ostensibly it is driven by the ongoing crisis in Ukraine and increasingly by emerging problems in the Chinese economy. Now I say ostensibly because last week Wall Street told us that the Ukraine problem was already priced in, and these issues in China are not new, they're just becoming more publicly known. So what's ahead? As always, it could go either way, but what was notable this week was a decrease in the dip buying by traders and trading computers that we've seen pretty consistently up to this point. We also saw a divergence earlier in the month where the Dow did not react similarly to the Russell 2000, the S&P 500, and the NASDAQ Composite when they posted new record highs. Again, that was previously in the month. Now, as we set off in here at the summary, a correction is coming, but it is difficult, if not impossible, to determine when it will happen. But when it does, it is unlikely that those heavily invested in the markets will be able to get out in time. Now, if your time horizon to retirement is longer than 10 years, then this may be of little concern to you. If your time horizon is within 10 years, you're already retired, we hope you are paying attention. You have choices for your retirement savings that you may not be aware of, and we'll briefly look at one of those in a moment. On to other news. As of Friday, the national average percentage yield on a jumbo CD was 0.80%. Now this is a drop from the 0.82 to 0.84 we've been tracking every day in our daily statistical summary for frankly most of 2013. I was really surprised to see this average CD rate drop this week since interest rates, as measured by, again, the benchmark 10-year U.S. Treasury note yield, rose over 70% in 2013 and are still up over 30% since this same time last year. That's what we call a rolling point-to-point measurement. Now, on the subject of interest rates, the year-to-date yield on the benchmark 10 U.S. Treasury note is down over 12%. Again, this is calendar year 2014. This is resulting in the rates offered on safe money tools such as guaranteed annuities to decline. Now we've been seeing these declines in our rate updates in the office all for the past couple of weeks, but the good news is this drop is not so severe as to cause the core guaranteed lifetime income benefits that we use for what we call foundational income in retirement planning to decrease. However, the Fed's policy to force savers and retirees into the risk markets by downwardly manipulating interest rates continues. They do this ostensibly trying to stimulate the broader economy, but the reality is they've been doing this for years on the backs of retirees and near retirees. But fortunately, our insurance carriers are creative and innovative in offering financial tools that still offer reasonable earnings potential with protection against loss and lifetime income that you cannot outlive. If you're not familiar with these products, contact us here at Brokers Alliance or Outlook Advisors if you're a consumer, if you want to learn a little bit more how these might be able to help secure your retirement and your retirement income. Now finally, and on that note, it was widely reported this week that the legendary investor Warren Buffett has advised the trustees of his estate to invest 90% of his holdings after his death, in index funds, which of course is a passive investing strategy. Well, this leads me to conclude that Mr. Buffett is a believer in indexing as a means of growing money and frankly perhaps keeping it safe. Well, here at Brokers Alliance and Outlook Advisors, we believe in it too, but for those within 10 years of retirement or for those already retired, we believe in the indexing concept with a large measure of safety as part of it. Very briefly, this is how these financial tools called fixed indexed annuities work. Now, interest gains are based upon or linked to a market index such as the S&P 500 index. Now, when this index rises, typically measured over the space of a year, but there's variances, the index gain is credited as interest subject to a limit, and there's different levels and types of these limits. Now, why would you subject your gains to a limit? Well, because history tells us that markets will fall as well as rise. With an indexed annuity, when the index declines, there is no loss to account value or any previously credited interest. Now, this continues as long as your money is in the annuity. Now, these financial alternatives are not investments. They are insurance contracts. And none of your money is actually invested in the stock market. But for retirement income, there are optional benefits that provide a preset rate of growth for purposes of determining your lifetime guaranteed income as well. Now, of course, these guarantees are based upon the claims paying ability of the insurance company. Now, these instruments are intended for retirees and near retirees, and like all financial options you have out there, there's a lot of flavors of them, some better than others. Contact us here at Brokers Alliance, or again, if you're a consumer, at Outlook Advisors to learn more, as there is a lot of important details to cover. Again, just did it very briefly. Now, moving on, this is one of this week's quotes to share with clients. This is from Seth Klarman of the $27 billion Baupost Group, who reportedly wrote, "When the markets reverse, everything investors thought they knew will be turned upside down and inside out. Buy the dips will be replaced with, what was I thinking? Anyone who is poorly positioned and ill-prepared will find there's a long way to fall. Few, if any, will escape unscathed." Well, I certainly agree with Seth on that one. Now, that's all I have time for today, but be sure and check out the written summary. There's several good articles in there to share with your clients. Now, if you want to see something covered in the summary or have comments, just contact me at the email address scrolling along the bottom of your video player. If you're in the business and you want a better quality of true support in your life and annuity practice, again, more than just products, contact us here at Brokers Alliance. We'll take care of you. That's your Saturday summary for Saturday, March 15th of 2014. We'll see you next Saturday.